Hi everyone, welcome. I'm glad you could join us tonight. If you're here, you're probably starting to think about buying your first home, which is very exciting. But I also know it can feel like a lot at times, and that's totally normal. I'm Stacy Nichols, a loan originator with First Hope Bank, and I work with first-time homebuyers every day. A big part of what I do is helping people take what can feel like an overwhelming process and break it down into something that makes sense and feels doable. Tonight is really about that, giving you some clarity, answering your questions, and hopefully helping you feel a little more confident about what comes next. As we go through everything, feel free to drop your questions into the Q&A box. We'll make sure we come back to those at the end and answer all those great questions. All right, with that, I'm going to hand things over to Andrew, who is going to walk you through everything you need to know. See you at the end.
Good evening, everyone, and thank you for joining us for our first-time homebuyer webinar. We're really excited to have you here tonight. Whether you're just starting to think about buying a home or you're already in the process, our goal is to walk you through everything you need to know and help make the process feel a lot less overwhelming. We're going to cover everything from credit and budgeting to mortgage options and the home buying process, so you can walk away feeling more confident and prepared. At the end of the presentation, we'll open it up for a live Q&A, where you'll have the opportunity to ask questions directly to a mortgage expert. So feel free to jot down any questions as we go, and we'll make sure to get as many as we can at the end. Let's get started. Before we jump in, I want to take a quick minute to walk you through what we'll be covering today, just so you know what you signed up for. We really designed this to guide you step by step through the home buying process, from where you are right now all the way to closing day, which is the fun part. We'll start with credit and getting pre-qualified. Don't worry, we'll keep the credit talk as painless as possible. Then we'll get into what it actually costs to own a home and how to realistically save and budget for it. From there, we'll break down mortgage payments, because there's a little more to it than just one number. Go over all the different loan options and walk through the buying process so there are no surprises along the way. By the end, you should have a much clearer picture of how everything works, and hopefully feel a lot more confident about what your next steps look like. Let's start with everyone's favorite topic, credit. Don't worry, we'll keep this as painless as possible. Before we even start looking at homes or falling in love with something on Zillow, it's really important to take a look at your credit. We always recommend checking your credit report at least once a year, just to make sure everything is accurate and up to date. You'd be surprised how often little things pop up that shouldn't be there. And just keep in mind, small things like a missed payment or running up a credit card can impact your score pretty quickly. So if your score isn't quite where you want it to be yet, that's okay. This is your chance to clean up things before you apply. Your credit score is basically your financial report card. It tells lenders how reliable you've been when it comes to paying things back. When you apply for a mortgage, this is one of the first things we look at to determine what kind of loan and rate you qualify for. The good news is, it's not complicated to improve. It really comes down to consistency, paying your bills on time, keeping balances in check, and just building good habits over time. And this part is important. The higher your score, the better your interest rate. So even a small improvement can make a real difference in your monthly payment. Right now, in the mortgage world, we use what's called a tri-merge credit report, which means we're pulling scores from all three bureaus, Experian, TransUnion, and Equifax. So when people ask, which score do you use? The answer is all of them. That said, over the next few years, the industry is expected to shift toward a bi-merge report, meaning 2 scores instead of 3. But for now, we're still looking at the full picture. Now, let's talk about what those credit scores actually mean, because not all credit scores are treated the same. If you're in that excellent to very good range, you're in a really strong position. You're typically getting the best rates and the most flexibility. Once you get into the good range, you're still in great shape. Most loan programs are available to you, maybe just not the absolute lowest rates. When you're in the fair range, that's where things can get a little more limited. You can still qualify, but you may see higher interest rates or need a little more money down. And if you're below that, It doesn't mean home ownership is off the table. It just means we may need to take a step back, improve things a bit, and then move forward the right way. And I always like to remind people this isn't permanent. Credit scores can improve faster than most people think with the right habits. Now that we've tackled credit, let's talk about the next step, figuring out what you can actually afford, which is where pre-qualification comes in. Why get pre-qualified? You really want to know your price range and monthly payment. First, it helps you understand what you can realistically afford, not just the home price, but what that monthly payment actually looks like and how it fits into your budget. Because there's a big difference between qualifying for a payment and being comfortable with it, whether that's $2,500 or $3,000 a month. You want to understand your down payment. It gives you clarity on how much you'll need up front. The more you put down, the more flexibility you may have with your purchase price. But even smaller down payments can still get you into a home. The key is figuring that number out early so you can shop with confidence. Once you're pre-qualified, you can share a clear price range with your realtor. That way you're not guessing. You're looking at homes that actually make sense for you. What do you need to get pre-qualified? To get started, we'll just need some basic information, nothing too overwhelming. Your ID, driver's license or passport, your social security number for the credit review, income, pay stubs, W-2s, and other tax returns, assets like bank statements, employment, typically a 2-year history, and if you just graduated, we can often use school toward that, and other debts, credit cards, loans, etc. Once we have that, we can give you a pretty clear picture of what you can afford, and more importantly, what makes sense for you. Let's talk a little bit about the pre-qualification process. It's really very straightforward. You're going to meet with a mortgage loan originator. They're going to work with you to gather the information you need to evaluate your eligibility. Then you're going to provide us with credit authorization to pull those credit reports, which we talked about earlier. You're going to provide all those required documents that we need. Once the bank has all of that, all this information gets evaluated against what mortgage programs we have, and eventually a pre-qualification letter will be issued if you do pre-qualify. All right, so now you know what you can afford, but what does it really cost to own a home? Let's start breaking that down. First, let's talk about down payments. It's the big one. This is usually the first question people ask. The good news is you don't always need 20% down, though you might have heard. There are some options. With USDA loans, these can be 0% down if the home is in an eligible area. So yes, it is possible to buy with no money down. FHA loans, you can put down as low as 3.5%, which is great for buyers who may not have perfect credit. And then your typical conventional loan, typically around 3 to 5% down, depending on your situation. The key takeaway here, there are options. It's really about finding what fits you best. Let's talk about some of the gift options, especially a gift of equity. This is a great option that not everyone knows about. A gift of equity is when a family member sells you a home for less than its market value, and that difference becomes a gift to you. That gift can go toward your down payment or closing costs. It can reduce how much cash you need up front, and sometimes even help you avoid mortgage insurance. There are a couple requirements, like a gift letter and an appraisal to confirm the value. It's most common in family situations, but it can be a really powerful tool if it's available to you. And then there's mortgage insurance. This is one people don't love, but it's important to understand. Let's talk about PMI for a conventional loan. If you put down less than 20%, you'll have a monthly PMI payment added on. This amount depends on things like your credit score, loan size, and down payment. With FHA mortgage insurance, FHA loans include both an upfront cost rolled into the loan and a monthly premium. With USDA mortgages, it's a similar idea, an upfront fee plus a smaller monthly amount. Think of mortgage insurance as kind of the ticket price for getting in with a lower down payment. It's what allows you to buy sooner without having to save that full 20%. It's not forever in most cases, but it is something you want to factor into your monthly payment. Now let's talk about some of the other costs of home ownership. First of all, those closing costs. These can typically range from 2 to 5% of the purchase price. They include things like bank fees, third-party services, which are things that you can shop for. There's items that you can't shop for, like recording fees and transfer taxes. And don't forget also in there escrows and prepaids. These are funds for property taxes and insurance, appraisals, and hazard insurance. And this is usually where people say, okay, how do I actually make this happen? Let's talk about saving and budgeting. Let's talk about some of these smart saving tips. First of all, shift your mindset. Saving for a home isn't a sacrifice, it's an investment in your future. You can make small swaps, like coffee at home instead of Starbucks or Dunkin', and pay yourself the difference. It's surprisingly rewarding to watch that fund grow. And track your spending with an app or spreadsheet so you can spot easy opportunities to save more. When budgeting for home ownership, plan for ongoing maintenance. Things like lawn care, HVAC service, and small repairs add up. And be ready for the unexpected. When we bought our home, we always joked that everything is $1,000 because repairs always seem to land right around that number. So you want to make sure you build yourself a safety net. Aim for about 6 months of reserves so you can comfortably cover your mortgage and any surprises. To make this a little more real, let's look at what a typical monthly budget might look like, because seeing the numbers really helps it click. In New Jersey, a couple grosses about $8,500 to $9,000 a month, which nets out to about $5,500 to $7,000 a month. So this is how it breaks down. Housing, housing should be no more than 30% of your take-home pay. Here, out of that $5,500, that's $1,650. You want to make sure you're saving for that down payment. Use 20% of your take-home pay for that. Other essentials, utilities, groceries, transportation, all these other things really start to add up. And then you want some discretionary spending, non-essential expenses, going out, or putting that into additional savings. Now let's answer a question we get all the time. What actually makes up a mortgage payment? Because it's more than just one number. First of all, there's the principal. This is the part of your payment that actually pays down your loan balance. Think of it as building ownership. Every dollar here increases your equity in the home. Early in the loan, this portion is smaller, but it grows over time. Next is the interest. This is the cost of borrowing money from the lender. In the early years of a mortgage, a larger portion of your payment goes toward interest. Over time, as the balance goes down, you pay less interest and more principal. Also in there are taxes. This is your property tax, typically broken down into 12 monthly payments. The lender usually collects this and holds it in an escrow account. Keep in mind, taxes can change year to year, which can affect your monthly payment. Lastly is the insurance. This covers homeowners insurance and sometimes mortgage insurance if applicable. Also usually collected monthly and held in escrow by the lender. And this protects both you and the lender in case of damage or loss. Once you understand how payments work, the next step is exploring the different loan options available to you. First up is the USDA mortgage. This is where we're talking about the 0% down payment option. These are typically in rural areas, and some smaller suburbs of metropolitan areas may qualify too. FHA mortgages. This is ideal for first-time home buyers and those with less than perfect credit. And then conventional mortgages. This is where you can put down as little as 3.5%. Ideal for borrowers with good credit, lower interest for borrowers with higher credit. There are also adjustable rate mortgages and jumbo mortgages. Now, beyond the numbers, let's talk about the fun part, actually choosing the right home, and a few things you don't want to overlook. Let's talk about must-haves versus nice-to-haves. This is your bucket list of things you want in the home. Does it need to have 3 bedrooms? How many baths does it need to have? What are all those different things that you need to consider? Key considerations here: location and neighborhood. Are you looking for a particular school district for children? Are you looking for access to mass transit? All these types of things. What are the taxes in town? What are the utilities going to cost you? What's the age of the home, the condition, how much is it going to cost to maintain that? And how much size and space do you actually need? And while you're going through this process, there are a few things you'll definitely want to do and a few things you'll definitely want to avoid. Things to do: stay current on all your existing accounts. Don't miss a payment. Continue to use your credit as you normally would. Maintain credit availability. Preserve your bank balances for the down payment and those closing costs. And if you have any questions, call your loan officer. They're there to help. Things to definitely avoid: don't apply for new credit of any kind. Don't close credit card accounts. Don't max out or overcharge existing credit cards. All these things will ding your credit score. Don't make any big purchases before or during home purchase. Don't deposit any sums into your bank that cannot be documented. And dispute any item on your credit report. That's why we always recommend running that credit report at least annually. Before we move on, here are a few things to keep in mind. Think of this as your home buying cheat sheet. Remember, keep your financial information in your statements organized and up to date. Review that credit report. Keep paying your bills on time. Plan for that down payment. Save up. Line up gift funds, etc. Figure out where that money is going to come from. And maintain steady employment. All right, let's put it all together and walk through what this process actually looks like from start to finish so there are no surprises. I'm going to start right at the beginning, get that pre-qualification. Once you know what amount of home you can afford, that's when you're going to find the home, you're going to make that offer, you'll sign a contract, go through the application, appraisal order, the processing, the appraisal report. You will go through underwriting. Then you get the title report and any conditions on the home buying process. And finally, you are cleared to close. Once you're cleared to close, you're going to schedule that closing date. Make sure you do a final walkthrough before closing. Make sure any issues that haven't been addressed get addressed. Then you go through your closing, and congratulations, you are now a proud homeowner. Don't forget, always thank your loan officer. They're there to help you. So again, if you have any questions, reach out to them. And that brings us to the finish line, at least for the presentation. Now it's your turn. What questions can we answer for you?
All right, we're to the question and answer portion of the evening. Very exciting. I've been keeping an eye on all your questions, and I can see that they're all great. I'm going to start with the first one, work my way through. Hopefully, we can get through all of them tonight. Here's the first question. What happens if I switch jobs during the process? Well, that's a very good question. To be quite honest, it's not a bad thing. It's as long as you're staying in the same industry, if you were switching from one nursing position to another nursing position, even from a doctor's office to a hospital or things like that, that is a-okay. When it becomes a problem is if you were leaving nursing and going to be a mechanic. We would need to understand why that is going on and really get some good documentation that you were doing nursing as an interim and now you've got your, license to be a mechanic or something along the lines of that to be able to really close that gap and make our underwriter understand why all that happened. What happens if you get married during the process? That's okay. That's not an issue at all. We just end up keeping the loan in your maiden name, unless you can get the documentation by the time you close to all match. The marriage certificate, your social security, your driver's license, we need all information to match. If you get help with the down payment, that's okay. Gift funds are acceptable. We just need to source those gift funds. So throughout the process, whether it's mom or dad that are gifting you, let's say $15,000, what we'll do is we'll ask for a gift letter. We will ask for a copy of the front and back of the check. And we will also ask for that gift, the donor that's giving you mom and dad's bank account, to make sure that they had those sufficient funds to gift to you. How often can I expect communication from my loan officer? That's a very interesting question. And I communicate with my borrowers very, very often. I usually try and check in with them throughout the whole entire process, sometimes daily, sometimes weekly. It all depends on where we are in the stage of the process. But I'm very communicative through the whole entire process. There are some loan officers that work it a little bit differently. That's just how I work things. Okay, and the last question for the evening. How can I improve my credit? Well, there's many things that you can do. As we spoke in the presentation, managing your credit, keeping an eye on your credit report, making sure that everything is accurate is step number one. Step number two is making sure you keep, let's see, you have 5 credit cards, each credit card under 30% usage. Keeping it underneath the 30% usage is going to jump that score. If you have a collection account, we always urge you to pay off that collection account. That's going to help jump your score. There's other things once we get into reviewing your credit score that we can actually personalize how to really improve that. So that's the question and answer portion of the evening. I just wanted to really truly say thank you for taking the time out of your evening tonight to be with us. Before we sign off here, just a quick reminder that my contact information is on the screen. Also, my coworker, Virginia Green, is also another loan officer here at First Hope Bank. Our information is on our website. You can reach out to either one of us if we didn't get to a question tonight, or there's other things that you would like to discuss with us not here tonight. Definitely reach out. We're always here to help you. Also, we will be sending out a recording of tonight's webinar here shortly that you can revisit. Once again, thanks again for joining us. Have a wonderful evening.